Real estate investment presentation. Incremental borrowing costs. Get ready because we're raising the stakes with real estate. When thinking about incremental borrowing costs, we're basically asking the question of what is the cost to borrow more money at a higher interest rate? Often when we're thinking about home loans, the scenario being, should I put more money down upfront or less money down upfront? In other words, if we put more money down upfront, we would be investing more money upfront into the home and then taking out a lower loan. If we have the option then to take less money or put less money down upfront, then we would have a larger loan amount typically. Obviously, when we compare those two scenarios, we're going to have a difference in the loan amounts. Typically, the larger loan will have a higher interest rate because that's just generally how things will work. The question then being, is it worthwhile to put more money down upfront, or should you put less money down upfront if you have the option to do so? Obviously, cash flow would be a factor in that. The actual payment on a monthly basis and whether or not you can afford that would be a factor. And then we want to think about the incremental borrowing costs in terms of a rate as well, which could help us to answer some questions as well. So what is the required rate of return to justify a lower down payment? So a lower down payment versus a higher down payment. If you have a lower down payment, then you're going to have a higher loan amount. So determine the cash flow differences. That will be basically our tool that we're going to be using. Often the tool that we've been using in the past when you're comparing different scenarios is to break it down into the cash flows and then use that to help us calculate our rates. In this case, we're looking at the differences in the cash flow, the differences in the two loan amounts, and the related cash flow differences related to them, differences in essence in the payments, to help us figure out what the incremental borrowing cost will be. So the impact of loan to value ratio on loan costs is that the more we borrow, the higher the interest rate will be. So this is just going to be the general rule, of course, if we have a significant increase in the amount that we're going to be borrowing because of the structure of the loans, we would expect then the rates to be increasing. So there will generally be a higher rate usually when we take out a higher loan. Therefore, it is not rational to borrow as much as possible because the interest rate will be too high at some point. So obviously, we're not going to get to this point where we're going to say, we'll just borrow as much as we can. That's not generally going to be a good idea, of course, because typically the interest rates will go up, and at some point in time, it will not be economically a good idea to be borrowing more money. So the idea of, I'm just going to borrow more will not be a good idea generally. Now, some people, that might sound obvious, but when you're talking to some people, they tend to think that, borrow as much as you can, and then because you're going to get benefits from the home loan and so on, you could invest the difference someplace else. But even taking that into consideration, tax benefits and, the low rates and so on, the interest rates will, of course, be going up as you borrow more money. And so generally, it's not going to be a good idea. There's going to be some point at which you're going to say it's not going to be economically a good idea to borrow past a certain point. So if you're comparing two different scenarios, let's take a look at a quick example. We'll take a look at more examples in Excel and in OneNote practice problems, which I highly recommend taking a look at so you can get a better idea of this. But if you have the two scenarios here, you got the 20% down, which would be kind of like the standard scenario. Let's say we have the home at the $150,000. You've got the 20% down. That would be $30,000 down then up front. The $150,000 minus the down payment would give you the loan amount of the $120,000. We're going to assume this is a 30-year loan. 30 times 12 would be $360. The rate then we're going to assume at the 8%. Using the payment calculation, we get to the payment of $880.82. Now, if we compare that to a situation where we only put 10% down, same home value, but we're going to say we're able to only put 10% down, that would only be $15,000. That would mean that the loan amount would be $50,000 minus the 15, or $135,000. So we put less money down, and that means that, of course, we have a larger loan amount in that scenario. We're going to keep the years the same. Now, we do a practice problem where we change the years as well. That'll complicate things. But let's keep the years the same at 30, 360. Because we have a higher loan, you would expect the rate would go up. There's a significant increase in the loan amount. You would expect the way the loans work that we have an increase in the rate to the 8.5. The result on the payment then being an increase of $1,038.03. So then the question is, well, if I have the option, like if I have the money to put the money down up front, the 30,000, or not to, then what would be the best option for me to do? And so we could, of course, compare the payment amounts. And in this second scenario, we have a lower payment amount, which obviously could be beneficial if you put the 15 up front, and then you're depending on the cash flow that you're generating in the future. It would be nice to have the lower payments so that you can, pay those off. So that would be one factor that we would be considering. You can also look at the total payments under the two scenarios and the interest, which we calculate down here. You can take a look at the difference in the rates. It went from 8% up to the 8.5, and the difference being the 0.5%. But that's not really the rate that might be most applicable when you're making the decision of this incremental increase, the added 15,000. So you're adding the 15,000 on this side, and you're trying to see if it's worthwhile to put it into the loan. So to figure that, we'll figure out the incremental borrowing cost, which would be kind of like the real rate that might help with that decision-making process. Now, when you're thinking about this, in essence, the idea is you're saying, okay, if I have the option here and I have this other 15,000, if I have the ability to only put 15,000 down, should I then put the other 15,000 I have down up front, in essence, investing it into the home up front, lowering the amount of the loan that we would have? That would be one option you can do with the money. Or you could say, well, if I don't put the 15,000 up front and I just put this 15 and not the other 15, right? And I just keep it down here, and I still have that 15,000. If I had the ability to put it into the down payment, then maybe I could invest it somewhere else. And at what rate of return would I need to get? Would it be more wise for me to put it someplace else than put it into the loan? That could be a question that we would have. And then the other question would be, well, what if the rate goes up, then would it be wise for me to get another loan, a second loan, instead of putting the added 15,000 here? Maybe I should only put the 15,000 down and then see if I can get another loan for the added 15,000 to bring it up to the 20% instead of doing this scenario. Those would be kind of your three questions you might be asking. To help with that, you'd look at the incremental borrowing costs. So if we take this information, what you do is look at the differences between the loan. So the larger loan was 135 versus the smaller 120. The difference is 15,000. The incremental amount increase in the loan would be 15,000. The larger loan amount in terms of the payments resulted in 1,038 using the payment calculation versus the 880.52. So there's a difference in the payments of the 157.52. Now you can then figure out basically the rate, the incremental borrowing rate cost using the rate function, or you can use the IRR. The IRR being a little bit more intuitive and being easier to do if you have a bit more complex scenarios. We'll do both of those when we work the practice problem. But if you use the rate calculation, it would be the rate equals the number of periods. The number of periods then would be the loan term, in this case, of the 30 years or 360 we're picking up in months, comma, the payment amount. The payment amount's going to be the difference in the payments, and it's a negative, which would be this 157.52 in this case. And then comma, the present value is going to be the difference in the two loans. In this case, the 15,000, multiplying that 12 to bring it up from a monthly amount to a yearly amount. We get to that 12.279 about. So the incremental borrowing costs, the rate that we come to, in this case, that being, in this example, the 12.279, represents the real cost of borrowing the extra funds. So could we earn an equivalent risk-adjusted rate of return on the funds that is not invested in the property? So in other words, if I was not to invest the funds in the property, could I basically invest it and make an amount above that? Because if I wasn't to invest the funds in the property, meaning I didn't put this 15,000 in and I took the larger loan, in essence, I'm paying an incremental borrowing cost of the 12.279. So if I don't put it in the property, then I would have to get a rate of return higher than the 12.279 in order to make it a good decision to basically keep it and invest it. So can we borrow the added funds some other place for a lower cost? So again, our second option would say, well, if I have that 15,000, what if I take the lower amount here and then in the smaller loan, and then I see if I can pick up that 15,000 with another loan, possibly at a lower cost, a lower rate to pick up that added 15,000. That would be another option that we can do with it. Or of course, would it be worthwhile for us to just put the more money down, put the 15,000 down on the home in this case, which would result in the lower loan amount of the 120,000. Those are basically your three options.